Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial papers of big companies. And today we've got a juicy one from Medirom Healthcare Technologies Incorporated. Ever wonder how much a company's success relies on just a few key dates and numbers? Well, let's dig in and find out. If you like getting these straight answers without all the corporate jargon, make sure you hit that subscribe button and the notification bell. And hey, we've got a thriving community over on Discord, so check out the link in the description below to join the conversation. So, Medirom Healthcare Technologies Incorporated is giving us a peek behind the curtain with this filing. It is essentially a report for the first half of 2025, ending on the 30th of June. Think of it as a progress report showing us where they stand financially and what has been happening. Let's jump into some of the numbers that reveal the health of a company. We're looking at equity figures here, for instance, additional paid in capital is an important one. It represents money that shareholders have paid for stock above its par value. On the 30th of June 2025, this figure stood at a certain amount. Now it's helpful to see how this has changed over time. Looking back to the 31st of December 2024, we can see a comparison. This number often tells us about how much capital the company has raised from selling its stock. Then there is common stock. This is the fundamental ownership in the company. On the 30th of June 2025, this was a key component of their financial structure. Comparing it to the end of 2024 and even earlier dates like the 30th of June 2024 gives us a sense of how the company's equity base has evolved. It's like looking at the foundation of a building to see if it's growing or shrinking. Treasury stock is when a company buys back its own shares. On the 30th of June 2025, this was also on the books. Seeing the figures for treasury stock compared to previous periods like the 31st of December 2024 and the 30th of June 2024 can indicate if the company is investing in its own stock, perhaps as part of an employee incentive program or believing its shares are undervalued. Retained earnings are profits that a company has kept and not distributed to shareholders as dividends. For the 30th of June 2025, this number is crucial. It shows the accumulated profits, comparing this to the 31st of December 2024 and the 30th of June. 2024 tells us if the company has been consistently profitable and reinvesting in itself. A growing retained earnings figure is generally a good sign of a healthy, growing business. Non-controlling interest represents the portion of equity in a subsidiary that is not owned by the parent company. For the 30th of June 2025, this figure gives us insight into the company's consolidated financial statements. Tracking this over time, like comparing it to the 31st of December 2024. And the 30th of June 2024 is important for understanding the full scope of the company's operations, especially if they have many subsidiaries. Now, let's talk about debt. Debt is like borrowing money, and companies use it for various reasons. We see here a mention of short-term debt maturing on the 31st of March 2026. This is a commitment to pay back money within a relatively short period. Similarly, there is short-term debt maturing on the 31st of December 2025. These dates are critical. They tell us when the company needs to repay these borrowed funds. Keeping an eye on these short-term obligations helps us understand the company's immediate financial flexibility. We also see a specific short-term loan mentioned for 266 million yen with a maturity date of the 31st of March 2025. This gives us a concrete number for a specific borrowing. Understanding these loan details the amount, currency, and maturity date is key to assessing financial risk. Common stock can sometimes be broken down into different classes. Here we see common class A stock. On the 30th of June 2025, this was part of their equity structure. Comparing it to previous periods helps us understand the composition of their ownership. Convertible debt is debt that can be converted into shares of the company's stock. We see references to this for October 2024 and also for the year 2022. This type of debt can be a bit tricky. If the company's stock price goes up, bondholders might convert their debt into stock, which can dilute existing shareholders. It's a way for companies to raise money with a lower interest rate upfront, but with the potential for more shares later. Looking further out, there are mentions of debt or financial obligations that extend to dates like the 1st of January 2029, the 1st of January 2028, the 1st of January 2028, the 1st of January 2027, the 1st of January 2026, and even the 1st of January 2030. These are significant long-term commitments. They indicate the company is planning its finances far into the future, which can be a sign of confidence. but also means they have long-term obligations to manage. Now let's shift to revenue. We see mentions of royalty revenue. This is income earned from allowing others to use the company's intellectual property, like brand names or systems. And this royalty revenue is specifically linked to the relaxation salon segment. This tells us a key part of their business involves earning money from their relaxing salon services being used by others. We also see revenue from product and service other. This is a broad category for income generated from various other products and services that don't fit neatly into other segments. This product and service other is associated with the digital preventative healthcare segment. This suggests Medirom is involved in offering healthcare services through digital means, and this may include product sales or other associated services. The company is broken down into operating segments. These are the different parts of the business that generate revenue and are reported separately. We see several of these: relaxation, salon, luxury beauty, and digital preventative healthcare. We also see corporate and eliminations, which is basically the central functions of the company and any segment transactions that need to be removed for reporting. We have franchisor-owned outlets. These are stores or locations that the company directly owns and operates. And then franchise outlets. These are locations that are owned and operated by independent franchisees who pay fees and royalties to Medirom. Understanding the mix between these two is vital. A high number of franchisor-owned outlets means more direct control and potentially higher profit margins on sales, but also greater operational responsibility. A large franchise network means faster growth potential with less capital investment, but lower per unit margins and reliance on franchisees' performance. Sublease revenue is income from renting out space that the company itself has leased and is then subletting to others. Staffing service revenue is clear enough income from providing staff to other businesses. Other franchise revenue could be from less common franchise arrangements or related services. And franchisor-owned outlets sold. This indicates revenue from selling off company-owned locations. This can be a strategic move to reduce capital expenditure or focus on core operations. The luxury beauty segment tells us another focus area for Medirom. We see a specific loan here, the Medirom Mother Labs loan, dated the 18th of March 2025. This suggests a particular financing arrangement, possibly related to a subsidiary or a specific project named Mother Labs. Another short-term loan, this one maturing on the 31st of October 2025. This is a very near-term obligation. Unsecured short-term bank loan. This means the loan is not backed by any specific collateral, implying a level of trust from the lender based on the company's creditworthiness. Medirom Mother Labs Incorporated is mentioned, along with individuals like Yasuhiro Hayami and Issei Human, in relation to specific dates in December. This likely points to some corporate actions, perhaps board appointments or significant decisions involving this entity. Investor-owned is mentioned in relation to the 30th of June 2025 and the 31st of December 2024. This might refer to a category of business operations or investments where external investors hold ownership. Representative director is a role within Japanese corporate governance. Kazuyoshi Takahashi is identified with this title and linked to the 30th of June, and later to January through June 2025. This suggests leadership within the company. Relaxation Salons as a member, for the period the 1st of January to the 30th of June 2025, points to a specific operational unit or a focus within the broader relaxation salon segment. Common shares is a general term for the most basic form of stock ownership in a company, again for the first half of 2025. SRT minimum member and SRT maximum member appearing with Japanese financial institutions. Unsecured bank loans on the 30th of June 2025 are interesting. This likely refers to a range or a minimum and maximum exposure to these types of loans, perhaps within a portfolio. We see another short-term loan maturing on the 30th of September 2025. This adds to the picture of their short-term liabilities. The convertible debt is also listed for the 31st of December 2024, showing its presence on their balance sheet before the period we're focusing on. Looking at the franchisor-owned outlets, we see figures for January to June 2025 and also for the full year 2024. This helps us understand the magnitude of their directly operated businesses. Subsequent events are important happenings that occur after the reporting period, but before the report is filed. We see mentions of subsequent events related to debt maturing in 2025 and 2026, and also a general one for the 31st of July 2025. These are crucial because they can significantly impact the company's financial position, even though they happened after the reporting date. For instance, Securing new debt or making a major acquisition after the 30th of June would be disclosed here. Fair value measurements recurring tells us how the company values certain assets and liabilities that are revalued regularly. We have figures for the 30th of June 2025 and the 31st of December 2024. This is important for understanding how market fluctuations affect their reported asset values. Corporate and eliminations as an operating segment for the 30th of June 2025 and also for the first half of 2024. This confirms that the central costs and adjustments are a tracked part of their financial reporting. Employee stock options are a form of compensation. We see mentions for both January-June 2025 and January-June 2024. This tells us about their incentive programs for employees and how they account for the potential dilution from these options. Level 3 fair value inputs are the least reliable valuation methods based on unobservable data. When a company uses these significantly, it can be a red flag, suggesting that the true value of certain assets might be quite different from what is reported. We see this in relation to non-recurring fair value measurements for 2024 and 2025. A high reliance on level 3 inputs for significant assets could mean more subjective valuations and thus higher uncertainty. Additional information on convertible debt is also provided with specific maturity dates like the 31st of October 2025 and the 31st of December 2022. This gives us a more granular view of their debt obligations. We see a mention related to directors, employees, corporate auditors, and outside service providers in relation to a subsequent event on the 18th of July 2025. This could potentially involve equity grants or some form of compensation or agreement with these groups. Fair value measurements non-recurring deals with assets and liabilities that are revalued only when specific events occur. Again, seeing the level 3 inputs here for 2025 and 2024 raises similar questions about valuation subjectivity. Trademarks, other intangible assets, customer relationships, computer software, intangible asset, and reacquired rights represent various forms of intangible assets. These are crucial for businesses like Medirom, which likely derive significant value from their brand's technology and customer loyalty. Their values as of the 30th of June 2025 and the 31st of December 2024 show us the company's investment in these non-physical assets, which can be a major driver of long-term value. The mention of a representative director alongside common stock and common class A on the 30th of June 2025 likely indicates a link between company leadership and share ownership or issuance. Now let's talk about what all these numbers and categories mean for Medirom. First off, the company is clearly diversified across several segments, from healthcare to beauty to salons. This diversification can be a strength, spreading risk across different markets. However, it also means they have to manage many different types of businesses, which can be complex. Their debt situation, particularly the short-term loans, is something to watch. While companies use debt to grow, we need to see if they can comfortably meet those repayment obligations. The mention of convertible debt is also interesting as it could lead to future dilution for shareholders, but it might also be a cost-effective way to finance growth if the stock performs well. The reliance on level 3 fair value inputs for non-recurring measurements suggests that some of their assets valuations might be more opinion-based than fact-based. This isn't necessarily bad, but it does add a layer of uncertainty. For instance, if they're valuing a unique piece of technology and there aren't many comparable sales, they have to make their best guess. And that guess could be off. The fact that they're reporting on specific segments like relaxation salons, luxury beauty, and digital preventative healthcare is good for transparency. Shareholders can see where the money is coming from and where the company is focusing its efforts. It also highlights the importance of their intangible assets brands. Customer relationships and software are likely huge drivers in these service-oriented businesses looking at their financial health. The trend in retained earnings will be a key indicator of overall profitability. If that's growing steadily, it suggests the business is generating more profit than it's spending. On the flip side, if they're consistently buying back shares or taking on significant debt without a corresponding increase in earnings, it might be a sign of a maturing or struggling business. Overall, Medirom seems to be a complex business with multiple revenue streams and a commitment to growth, indicated by their various debt instruments and strategic segments. The key for investors will be to monitor how effectively they manage their diverse operations, repay their debts, and how the value of their intangible assets holds up. That is our breakdown of Medirom Healthcare Technologies Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description to join our community. Thanks for watching. See you next time.